Welcome to Tech I Spy, the channel where tech, finance, and future collide. If you're new here, hit subscribe or follow. And for returning listeners, you know the drill. Buckle in, eyes forward, thinking caps on. We're going deep. Now, before we get started, if you're serious about tech investing, don't forget to check out the Tech I Spy Kindle series. It's where we unpack entire sectors, from space to death tech, quantum to FinTech, with monologue-style breakdowns built for curious minds. You'll find links in the description. So what do we do here at Tech I Spy? In simple terms, we break companies down to the bone. Every episode, one target. One company. We look for strengths, weaknesses, opportunities, and threats. What the business world calls a SWOT analysis. But not some generic, cookie-cutter version. Ours are long-form, investor-focused, and made for those who think a little deeper than the headlines. And today, we've got a live one. TeraWulf Inc. Now at first glance, you might think, another Bitcoin miner. What's the hook? But listen closely. This isn't your average crypto operation. This is a company wiring Bitcoin directly to hydropower and nuclear reactors. A miner that claims it's mining clean. It's not hiding in Icelandic caves or sucking up coal power. It's building data centers next to nuclear plants in Pennsylvania. It's leaning into carbon-neutral mining like it's a movement, not a tactic. Which begs the question, is this smart? Is it viable? Or is it greenwash dressed up for the NASDAQ? TeraWulf says it's ready to be the ESG-friendly face of crypto. Their stock ticker is Wulf and wolves, after all, move in packs or they die alone. So let's begin. Let's break this down. Strengths, weaknesses, opportunities, threats. This is Tech I Spy, and this is your deep dive into TeraWulf Inc. What do you do when the world turns on crypto? When governments balk, environmentalists rage, and Bitcoin miners are cast as villains burning the planet one hash at a time. If you're TeraWulf, you don't argue. You pivot. You build your mines next to hydroelectric dams and nuclear power stations. You turn the narrative on its head. TeraWulf's greatest strength lies in its origin story. Not born from tech bros or libertarian gold bugs, but from veterans of the US energy sector, led by CEO Paul Prager, a man who cut his teeth in oil, gas, and infrastructure finance. This isn't a startup guessing at grid dynamics. It's a team that knows how to negotiate megawatts, read ISO market signals, and forge power purchase agreements that span decades. They aren't mining Bitcoin in cheap overseas sheds. They're placing ASICs near baseload zero-carbon power. And they're doing it in America. At the Lake Mariner facility in upstate New York, TeraWulf taps directly into hydroelectric power. It's not theoretical. It's not pending approval. It's live. In Pennsylvania, they've joined forces with Talon Energy to build the Nautilus crypto mine, which draws from a nuclear power plant. Not only does this provide clean, cheap, and constant power, it gives them a regulatory shield. Nuclear is politically protected infrastructure. No brownouts, no shutdowns during a heat wave, no last-minute carbon taxes because the mine runs on coal. Their partners are regulated utilities, not shady brokers. And here's where it gets sharper. By owning their infrastructure, not leasing rack space from third parties, they lock in long-term margin control. Their costs per mined Bitcoin are among the lowest in the industry. In Q1 2024, their cost of self-mined Bitcoin dropped to under $20,000, while the market price floated over $60,000 at times. That's not just mining, that's printing margin. At full capacity, they're projecting over 160 megawatts of clean energy powering operations, a scale that rivals or beats many public peers. Now look at their capacity ramp. In 2023, they scaled from approximately 60 MW to nearly 100 MW operational capacity, and their goal is to double that. Most Bitcoin miners cut back during crypto downturns. TeraWulf machines, or declared back Wulf, added racks and refined its cooling systems. It's a classic contrarian move. Build in the bear market, harvest in the bull. They've also embraced vertical integration in a way most miners fear. From procurement of ASICs to data center control, they maintain tighter operational discipline than many competitors. They don't just rely on third-party financing or hedge funds to bankroll them. They've taken on strategic equity partners instead of raw debt, keeping their cap table more resilient during volatility. And when it comes to environmental optics, they're practically bulletproof. TeraWulf was one of the few firms welcomed by ESG-aligned investors, thanks to its nuclear and hydro commitments. Let's not forget the brand narrative either. Most Bitcoin companies struggle with perception. TeraWulf leans into it. The name itself, Wulf, evokes instinct, ferocity, pack loyalty. But instead of raw aggression, they've wrapped it in sustainability and discipline. They mine Bitcoin like an energy utility, not a casino. That lets them tell a different story to regulators, pension funds, and institutional allocators. The ones who care less about crypto freedom and more about carbon credits, uptime guarantees, and political cover. And here's the final kicker: location, legislation. By anchoring themselves in US jurisdictions with favorable energy pricing and infrastructure, they avoid the nightmare scenario of mining bans, sudden tariffs, or unstable sovereign partners. Unlike firms that fled to Kazakhstan or rural China for cheap rates, only to be exiled when policy shifted, TeraWulf bet on American soil, American power, and American governance. That may not excite the maximalists, but it delights investors who think in decades. In summary, TeraWulf's strength is not just that it mines Bitcoin, it's that it mines it cleaner, cheaper, and more securely than almost anyone else in the business, all while flying the ESG flag high. If the crypto industry survives regulatory scrutiny and demands legitimacy, companies like TeraWulf will be held up as the acceptable face of the industry. And if the price of Bitcoin goes parabolic again, they'll be holding the golden end of the pickaxe. Let's talk about what keeps this company up at night, or should. Because behind the green gloss and impressive site photos, TeraWulf is walking a financial tightrope, and it's a long way down. The first, and most obvious, weakness is capital intensity. TeraWulf is not lean. It's not agile. It's not a couple of laptops and a cloud wallet mining Bitcoin in a coffee shop. It is industrial scale, and with that comes industrial costs. Everything, the land, the transformers, the cooling, the staff, the ASIC machines by the thousands, it all costs money. Big money. And much of that money had to be borrowed or sold off as equity. This is a company that's had to dilute shareholders repeatedly to survive. Look at the cap table. It's not a flattering picture. Share count is ballooning. In 2022, They executed multiple rounds of financing just to stay alive during the crypto slump. Every time the market turned bearish, WFF stock turned blood red. And here's the cold truth. TeraWulf has never turned a profit. Not once. It is burning cash while talking sustainability. Even in periods of high Bitcoin prices, it struggles to convert those gains into free cash flow. Why? Because they're constantly racing to expand, just to keep up with the difficulty curve. Bitcoin mining isn't static. Every day, the hash rate increases. Every cycle, the rewards half. And with the most recent halving in April 2024, the economics became even more brutal. Block rewards fell from 6.25 to 3.125 BTC. That means every machine now earns half while drawing the same power, analysts have noticed. Some have questioned the sustainability of the model, not from an ecological standpoint, but from an economic one. There's a growing chorus asking, what happens if Bitcoin plateaus for a year? What if the price drops below $30,000 and stays there? Suddenly, the cheap electricity doesn't look so cheap when you're paying fixed costs on megawatt-scale facilities. Then there's the debt profile. In 2023 and early 2024, TeraWulf loaded up on structured financing tied to machine purchases and infrastructure expansion. Some of it is senior secured. Some of it converts to equity. All of it comes due eventually. If Bitcoin fails to soar, the debt could crush them, and if it does soar, early financiers may dump converted equity into the market. Either way, the common shareholder is not in the safest position. Let's talk about asset concentration. They're heavily tied to just two primary facilities: Lake Mariner in New York and Nautilus in Pennsylvania. That's a tight operational footprint for a company trying to claim industry leadership. Any disruption, a regulatory crackdown, a grid reliability issue, or even something as mundane as a transformer fire, could take down a huge portion of their operational capacity. They are not diversified geographically nor politically. And yes, political risk still exists. Just because you're hooked up to a nuclear power plant doesn't mean your neighbors like it. The same New York regulators who gave TeraWulf a pass have slammed the door shut on others. The climate lobby is fickle. One shift in state-level sentiment, one high-profile investigation into the broader crypto industry, and suddenly TeraWulf becomes guilty by association. ESG status is not permanent, and Bitcoin itself remains controversial among institutional investors. There's also concern about executive overlap and governance. Paul Prager, the CEO, is also chairman. He has deep roots in Wulf Energy, a private energy company with close ties to TeraWulf. Some critics argue the lines are too blurry between the entities. Who benefits more from the partnerships, TeraWulf shareholders or private interests upstream? There's no scandal on paper, but there's enough complexity to make serious investors squint. And finally, let's talk about the product. Because this is the awkward truth no miner likes to say out loud, TeraWulf does not create value. It extracts a commodity. There's no intellectual property, no defensible tech moat. They don't own Bitcoin. They race others to earn it, and they must forever compete against newer machines, cheaper electricity, and more aggressive miners on every continent. That's not a business model built to last. It's a margin arms race. If you stop growing, you start dying. In summary, TeraWulf is a company that wants to be seen as forward-looking and green. But beneath that are structural cracks. It's asset-heavy, dilution-prone, and trapped in a sector where the rules change every 4 years. And in the shadows of every earnings call looms a single brutal question. Can this model survive the next crypto winter? Or is it just one bull run away from collapse? Bitcoin is a strange beast. It dies in headlines a dozen times a year, but always seems to rise again. For miners like TeraWulf, that cycle is oxygen, and the next halving cycle, already underway as of April 2024, might turn out to be their most lucrative opportunity yet. If history holds, a major rally could follow. The 2020 halving sparked a 2-year bull run that took Bitcoin to $69,000. If similar conditions emerge, high inflation, fiat skepticism, or central bank easing, TeraWulf stands to print revenue, not just coins. Remember, their cost per Bitcoin is under $20,000. If BTC climbs back above $70K, that's not just margin, that's velocity. More importantly, they're poised to benefit from a shift in who is allowed to profit from crypto, with spot Bitcoin ETFs now live in the US, and BlackRock, Fidelity, and ARK invest in the game. Bitcoin has been partially de-risked for institutions. But these ETFs don't mine, they buy, which leaves a hole in the portfolio. What if a sovereign wealth fund wants Bitcoin exposure, but with a climate-positive story to match? They can't buy Kazakhstan hash power. They can't pitch fossil-fueled miners to a green board. But they can point to TeraWulf and say, American-run, nuclear-backed, ESG-aligned, audited. That's not just good PR, that's a funding narrative. The infrastructure itself is also an opportunity. Bitcoin isn't the only thing that can be processed in a data center. These buildings, with proper upgrades, could run high-performance computing, AI workloads, or even act as reserve capacity for grid stability services. If the Bitcoin economy ever crashes or shifts, TeraWulf's assets aren't dead. They're repurposing. We're talking about hardened, climate-controlled, energy-intensive sites with direct utility access. The rarest thing in America's digital landscape today is not cloud talent. It's raw power, physically deliverable. TeraWulf owns that, and there's an even bigger angle. US energy policy is changing. With new federal credits, nuclear support subsidies, and bipartisan push for onshore industry, companies that align themselves with domestic energy will benefit. TeraWulf is essentially a patriotic miner, not outsourcing to China, not floating on Tether, but based in the US, tied to regulated utilities that aligns them with current geopolitical sentiment. In a world where energy security is now national security, this miner might be welcomed into corridors that once wanted crypto gone. Then there's the machine cycle. TeraWulf has already deployed large fleets of efficient miners, but new machines are coming, better ASICs with higher hash rates per kilowatt. As these hit the market in late 2024 and beyond, the firm's ability to swap out old rigs could significantly enhance productivity. If they execute well, they could lead the next generation of industrial-scale, low-carbon, high-efficiency Bitcoin production. Also worth noting, their public listing itself is an asset. Most global miners operate in legal gray zones or as private entities. TeraWulf is SEC registered, transparent, and on the NASDAQ. That opens the door to strategic partnerships, M&A, and inclusion in green tech indices. If a larger energy company, say a NextEra or Dominion, wants to test crypto infrastructure without the backlash, TeraWulf is a clean entry point. And if consolidation comes to the mining sector, which is likely, TeraWulf is a prime acquisition target, especially given its site proximity to stable power. And finally, don't underestimate the optics of the narrative. The media may tire of meme coins and scams, but they're always hungry for real tech. A story about a US company mining digital gold next to a nuclear reactor. That's click-worthy. That's fundable. That's documentary material. If TeraWulf can ride that wave, if they can translate image into investor confidence, if they can keep the ESG lobby on side while surviving the next market downturn, they could become the poster child of regulated, responsible crypto infrastructure. Bitcoin doesn't care about your business plan. That's the first truth every miner learns. It doesn't care about your green credentials, your ESG reports, your nuclear hookups. It is a mathematical network. It gets harder every day. It rewards less every 4 years. And it answers to no boardroom. The greatest threat to TeraWulf isn't internal. It's the economic logic of Bitcoin itself and how few people truly understand it. In April 2024, the Bitcoin halving occurred, cutting mining rewards in half, from 6.25 BTC per block to 3.125. This wasn't a surprise. It was baked into the code, but it was still brutal. It means that TeraWulf, like every other miner on Earth, is now working twice as hard to earn the same amount of coin. Their power costs didn't halve. Their equipment didn't magically improve. Their debt obligations didn't pause. The same fire, half the flame. And unless Bitcoin's price rises dramatically and sustainably, margins everywhere are being squeezed, even in the cleanest facilities. But the bigger threat isn't just price, it's difficulty. Every time another miner somewhere spins up more machines, the global hash rate climbs. That means the math gets harder. Blocks take more work to solve. TeraWulf might have cheap electricity, but they're still swimming upstream against a current that never stops. Unless they constantly upgrade their fleet, at high capex, they risk becoming obsolete. Older machines become unprofitable. Facilities built around them turn into stranded assets. The industry doesn't slow down. It consumes itself. Then there's the macro environment. What if interest rates stay high for years? What if Bitcoin enters a long sideways drift? TeraWulf has built a business for bullish conditions. It can survive the bear, but it can't thrive in it. And if another black swan hits, an ETF collapse, a massive exchange scandal or a global crackdown on crypto assets, investor appetite for the entire sector could vanish overnight. That would hit Wulf stock hard and funding harder. The regulatory front is another battlefield. Even though TeraWulf tries to be the good guy, clean energy, domestic sites, public listing, it's still a Bitcoin miner. And that's a dirty word in some political circles. If the US government decides to clamp down on energy usage, carbon accounting, or crypto risk, they won't make an exception for the ESG miners. Bitcoin itself is still seen as speculative, volatile, and linked to crime by many regulators. If mining is ever labeled a national security issue, or worse, a climate emergency contributor, TeraWulf could find itself squeezed out by zoning, permits, energy rationing, or flat-out bans. Let's not ignore climate narrative volatility. Today, nuclear is clean and cool again. But sentiment shifts. If activists turn on nuclear again, or if there's a plant accident anywhere in the world, that halo could dim. TeraWulf's entire identity is tied to its clean power story. If that narrative cracks, so does its unique market advantage. Then we have technological disruption. ASICs are advancing fast, and every new generation renders the old one inefficient. If TeraWulf doesn't buy and deploy the latest machines at the exact right time, they fall behind. But buying early is risky. Prices are high, tech isn't field tested, and capex is tight. One wrong call, and they're stuck with $100 million in gear that can't compete. Competition is also tightening. The next generation of miners aren't just coming from Texas or Georgia. They're being built by sovereign actors. Nations like Russia, Iran, and China are building state-backed mining operations with direct access to free or subsidized power. TeraWulf is a private company paying negotiated rates. If nation-states join the mining race in earnest, public miners will be outgunned, no matter how clean their energy. And finally, there's the market's memory. Investors are still burned from 2022. They remember when Core Scientific filed bankruptcy, when Riot's share price collapsed, when miners dumped BTC just to keep the lights on. TeraWulf may be cleaner, sharper, and more disciplined, but in a market panic, no one reads the ESG report. They just sell. So the threats are not idle speculation. They are structural, systemic, and cyclical. TeraWulf is trying to build a cathedral on an earthquake fault, noble, ambitious, but not without risk. If the price of Bitcoin climbs, if regulators soften, if energy prices remain stable, and if capital keeps flowing, TeraWulf could emerge as a flagship. But if even two of those threads snap at once, the entire scaffolding could collapse. This is the game they've chosen. And in Bitcoin mining, there are no second lives, only uptime or downtime. That's the rundown. TeraWulf, a company trying to mine the future without burning the past. Clean power. Big ambition. But make no mistake, this isn't a safe bet. It's a bet with teeth. You're wagering on crypto, climate, capital, and code all staying aligned long enough to matter. That doesn't make it foolish. It makes it fascinating. If you found this breakdown useful, hit subscribe or follow wherever you're listening. And if you want more, much more, check out the Tech I Spy Kindle series. Dozens of deep dives like this, covering every sector from space to death tech, quantum to FinTech, all written for serious thinkers and long-view investors. You'll find the link in the description. New episodes drop every week. One company. One big question. Strengths, weaknesses, opportunities, threats. Because the tech world moves fast, and if you're not looking closely, you'll miss the signal in the noise. This was TeraWulf. This was Tech I Spy. Until next time, keep watching the wire.